welcome to Trading with Technical Indicators. My name is James Boyd. Happy October 13th. You knew exactly what color shirt I was going to wear and dusted it off, and we're trying to actually help the market get a little bounce here. Now, when the market had sold off aggressively before, this shirt was worn in three presentations in a row. That actually did mark the bottom. I'm not calling the bottom, but this is day one of the green shirt. So let's see if we can help the market here. Little fun with you, okay? And just real quick, we got Rachel in the chat. We welcome her. And we welcome JP, BJ, Thea, Chena, Gary, Will, and many others. Welcome to you. And just remember, you can follow Rachel or myself on X. We do post educational content there and also announcements as well. Just real quick also, as we get going here, remember the information here is provided for general informational purposes only. When we talk about, or if we talk about options, remember that options carry a high level of risk and are not suitable for all investors. Also understand that when we talk about examples, we will do those in the Paper Money software for educational purposes only, especially when you're trying to learn maybe about different trading strategies, whether it's bullish or bearish. Feel free to use Paper Money, okay? That's what it's there for, okay? Now, Paper Money can actually be different than real in the fact that there's not emotion. Okay, and that could actually be different. Now, also remember that investing involves risk, including loss of principal. Now, today we'll talk about, we're going to look at it kind of like a 50-50 examples of bullish and bearish. I've had some questions that lingered from Friday on bearish, and so I want to kind of touch on that here today. However, I do think there are some examples of where we could talk about some bearish technical analysis in our examples. There are some charts that might be trying to pull back or have been falling. Now, I think it's a good goal that when markets actually fall, that you could actually say, hey, if things were going to go down, how do I protect myself? How do I identify exits? How do I maybe consider, let's say, a bearish trade? And which strategies might you consider? That could be, for many investors, a part of investing or trading in general. Now, just real quick, I want to kind of pull this up. So Friday night, Kevin and I, we did the ETF class Friday morning. And then what you're going to notice is there was, as you guys know, and gals, there was a little tweet that was actually sent out probably like an hour after we were done. And I was kind of like, I just opened up this Paper Money account for the first time really since last Thursday, okay? And you're going to kind of see that if I was just kind of looking to kind of see where the portfolio swung from. Really on the 9th, it was at 37.5. On the 10th, 35.5, down 2. So it was about a 5% push down on the market. Now I'm showing you this to kind of show you if you get kind of things that drop, portfolio could drop. Today, kind of back up to 36.5. So if we kind of say from where this was to where this was, it's really down about 1,000. So let's just kind of say that it's maybe down. You could kind of see the percent or so. Percentages, I won't state what that is from here to here, but it's down some, okay? Now, we haven't done any trades since Thursday, okay? Now, you're going to see, like, when we look at the IRA, now, by the way, this is also important to point out, in some of the trading examples that we have done, you might not ever consider those. So this balance, when we're looking at it, it doesn't even matter. But I am looking to kind of show that, you know, if we get market pullbacks, regardless of the strategies that we trade, portfolios are going to tend to be pushed down if your portfolio is bullish. Now, it's at 122.3. It actually got down to 118.277. We're right back actually to 120.144. Okay. Now, I haven't even looked at the portfolio. Okay. So what we're going to do in just a sec is we're going to pull up now kind of where these indices are. Now, if we pull this up, and when I say this, I'm saying the indexes, we had been in a trend-free condition. We had actually had green lines on the moving averages. And kind of like the dam breaks, if you will, if we start going into trend 5 or trend 4 or trend 5, you know, because trend 5 is the first time the momentum starts to drop. And if you go momentum starting to drop, those short-term sellers could start to sell. They start selling, it breaks support. You start to break support, you make a fresh new lower low. And then if you make a lower low, the highest chances to make a lower high. And all of a sudden, what was trending to the upside is now pulling back. So why would you care about learning about pullbacks? Well, because if you don't understand what pullbacks are, you're not moving up your stops, you're not seeing where the defense is, you're not seeing actually where the exit could be, and so on. And that's why you want to be familiar with kind of what is trend 4, what is trend 5, and then what are kind of maybe some methodologies, which we've talked about in terms of exiting and or protecting. Now, when we look at where these indexes are today, yes, they bounced back up. But I think when we go back to where we were probably on Friday, they were probably more trend 1, okay? Now, when we look at sectors, it's going to be a little bit more red. And if you look at the sectors, what you're now going to notice if you pull this up, this is what I really mean. Transport's number 1, okay? Real estate 1, financials 1, basic materials 1, energy 1, and you're going to look at discretionaries 1, and the one that I missed was right there, the consumer communications 1. Now, that's a lot of red. We haven't seen that much red on the chart. Now, here's the deal. If we're talking about an index or a sector, there's a pretty good chance that over time, that's the key word, over time, it could bounce back. If we're talking about an individual stock, that could be a little uglier because you're not dealing with a group of stocks, okay? You're dealing with one. But if we're talking about the index, if we're talking about the sectors, there's probably a greater chance it could bounce back, even though it's in trend 1. Could probably take time, but over time, it might work through the bad news. Now, the biggest thing I want to kind of show is when we pull these up, and I'm just going to fast fire these a little bit. If someone had a stop at all, okay, it probably got triggered, okay? There's the S&P 500. You pull up, let's say, the NDX, and you pull that up and you say, okay, if anyone had a stop at all, probably got triggered. That was a large red candle. And so here's the deal. What kind of feels bad about it, let's say that someone built a portfolio on Friday morning, the whole entire thing, only to see the market 2 hours later go down. Okay? I mean, that's a pretty tough scenario, meaning Friday morning, they just put on a whole entire portfolio, and then 2 hours later, the market drops. And so now they feel like, hey, my timing was horrible. Well, where were you the last month, 2, 3, 4, 5 year, 2 years, 5 years, 10? Where have you been? Okay, for any other time outside Friday morning. Now, here's the deal. What would have felt nicer is if the drop was a little slower. Okay, so that way we could kind of maybe make some moves potentially. But it feels worse when the drop is quick. So that's just what it is. And I think that's important to kind of understand is that it doesn't just happen in the stock market. My family, they actually, so my dad was an animal scientist with pigs. They had about 1.5 million pigs, about 10,000 head of cattle. And trust me, it doesn't just happen in the stock market, okay? You talk to someone in real estate, when you get interest rates to go up 2, 3, 4%-ish, it doesn't just happen in the stock market. You talk to someone that has a business, okay, it won't even go there. So it happens. But the moral of the story is if someone was trading over time, there was a chance that they actually had some profits in those. Didn't like to give back. Nobody likes to give back. But the biggest actually thing is the person who was probably hit the most is the person that Friday morning put on multiple positions Friday morning. Now, I want to kind of talk about some real quick. Now, high speed, low drag says that's a lot of bacon. That is true. That's a lot of beef too. Yes, it is. Yeah. So the little fun fact is, if you said, "Hey," well, I won't get into that, but let's say you had 1,000 head of cattle, beef cattle. I'm saying feeder cattle, and everyone weighs 1,000 pounds, and you had a 2% swing in the price. There's people that could be up or down $300,000-$400,000 just on that 2% swing. Okay, and then seeing a pullback in the market, it just doesn't really feel as bad as the farmers, okay? And speaking of the farmers, corn, soybean, things like that. So, but the biggest thing is I want to kind of talk about now is let's kind of talk about some positions. And I want to pull this up, okay? So this is kind of like where we kind of get to the point of like, okay, so let's say we have some positions And I want to double check and see, are there sell signals? Now, everyone wants to know about sell signals. The question is, when you explain the sell signals, potentially, it doesn't take very long. The hardest thing about sell signals is actually selling, okay? Now, selling could actually be a stop, like you trigger a sell. It could be like you're just manually watching, okay? In like example given right now. If I went into Microsoft and I looked at this and I said, is this a sell? Well, the first thing I actually see is we look at the 10-20 whole moving average, and you're going to see that it is red. The background color is red. And the 2.0 or 2 days, or the 1.0, 1 day, that they've had red moving averages for the last day or two. And I'm talking about trading days. Now, here's the deal. If this pulled back, which it did, it now is in a slight loss. Now, we kind of play these games with each other like, well, I don't want to lose. Well, the question is, do you want to lose? Are you okay with losing a little? Do you want to lose a little bit more? Or do you want to lose a lot? And the person says back, well, I don't want to lose anything. Then why are you here? Okay? If you run a business, you're a farmer, you're in the stock market, you're in real estate, you are in the business of investing and managing risk. Now, if we're talking about trading signals and using technical analysis as indicators to buy or sell, we don't like sometimes the negative outcome. I don't really know if this is a negative outcome, because if we go in here and I actually pull up, let's say, Microsoft and said, what does this look like? Is this a sell? If we pulled up this chart and said, what do we see right now? We actually see that the moving averages are both red, and there's a cross, and it broke diagonal support. Well, if we go in now and say, look, we're now going to sell it, cash is a position. Now, the hardest thing for investors to do is not that they don't recognize it, but now they're saying, well, if I get out now, I'm losing some. That's true. Not losing a ton, but what we're doing is we're going to right click, create closing order, and then sell. And what's going to happen is when the markets go, let's say trend 5 or trend 1, you're going to tend to actually have the highest amount of cash when the market is in the deepest part of the sell-off. Okay? So step number 1 is, do you have any stocks that meet exit criteria that you have not exited in your paper money account? That is step number 1. It's not that people don't know what to do. It's just that we procrastinate. And if we break that word up, we're a pro incrastinating in realizing that these positions are not bullish right now. Okay? Now, confirm and send. Now what we're going to see, now if it says illegal, what does that mean? It means that there's a stop on it. We're going to come in here, cancel OCO group, and now what we're going to do is right click, create closing order, and then we're going to sell. Now, if we do this, what you're now going to see is we're going to sell that position, and then Microsoft actually should become sold. There it is. Cash goes up. Now, does that mean that we could maybe go look to do something else? The answer is sure. Okay. Now, I'm going to come into this real quick. Let's say SO, Southern. Now, when you pull this up, now, here's the thing. Well, Kevin and I said on Friday, and we talked about how not everything's the same. There's some stocks that are actually trending decently to the upside, while others are not bullish, as we'll see in just a second. When I pull up Southern just real quick, let's kind of think of the sector real quick. That sector is utilities. And if you pull up the utilities, is everything the same? No, it's not. Okay? The utilities neighborhood has been quite bullish. Now, when we actually pull up, let's say SO, which is a utility company, we actually see they got a call, which has unlimited upside. And what you're now going to see is the put. Now, the put is really the side of the trade that has more, like you're doing more management with that, meaning you can only make so much, so you might try to take 50%, 65, 80%. We're not there yet, okay? Now, what I'm going to do is this is going to coincide with what we're going to kind of teach a little later on in this session. If we go back and look at this position, we go back and look at this position. What I'm going to do is I'm going to bring up Southern. Now, when we talk about trading, okay, so the first thing we're going to do is what could be a target on that? Now, this is our fibs from before. A target on this, if we use the 161 extension, was really $99. Okay? Now, this is my personal belief. It's my personal belief. Until you go to Pisa, Italy, and touch the statue, the feet of Michelangelo. No, it's not. Leonardo Fibonacci. Okay, but the other statue would be good too. Wrong city though. If you go to Pisa, touch Leonardo Fibonacci. Okay, then you actually know something about Fibonacci's. Okay, then you're qualified to speak on them. It's there. Okay. Now here's the deal. We're actually about 90 cents away from the target. So what do you think an investor might do? If I got 90 cents to go to the target, do you think we're going to set a stop down here at 95? Pretty foolish if you think about the reward to risk. So what we're going to do in this case is if we got 90 more cents to go to the target, we're going to actually set the stop the same amount to the downside. We're going to make it a 1-to-1 reward risk ratio. Okay? When you start getting within 1 to 2% of the target, you start tightening the stops. Now, James, does the investor take it from the current price in which you're seeing it at, or do you actually take it from the highest intraday price? The answer, we're taking it from the highest intraday price. What was the highest intraday price? The answer is the highest intraday price. If I put my cursor right on that, it was at 98.28. So what does that mean? Well, that would only give us 72 cents to actually go to the target. 98. Sorry about that. 98.28. I'm seeing what the difference was. 98.28. Should be 72 cents. Double checking. And now what we're going to see at 28, 72 cents. So if it was at 98.28, less what that remaining target was, we're going to set the stop at, or the condition to get out, the price, at 97.56. So we're going to go back in. How do we actually do this? As we manage the position, I'm going to click on this, hold the shift key down. Still hold it down. Click on both lines. Right click, create closing order, sell. Now what we're going to do in this case is we're going to come back, and I want to look at one more management, and we're going to talk about all new positions. This is the sell, okay? Now, here's the deal. It's easy to buy stuff. It's easy to buy stuff a lot of times. You can just go in, buy 1 share, 5 share, 10 share, okay? Selling it, setting a target, stops, manual exits, whatever. That's harder. You're actually now we're really starting to think here, okay, like a portfolio manager. Now I'm going to click on the limit. We're going to go to actually limit to market, data GTC. We're going to click on that gear right there. And when you click on the gear, what we're now going to do is go SO, mark, greater or equal to, and we're going to type in $99. Okay? $99, okay, is actually where we're going to put the target. If we go up to that point, which is the Fibonacci level, okay, sell. If we go less or equal to 97.56. Do you guys and gals know where we got 97.56? We took the highest intraday price, which was 98.28. We got to 98.28, that would be 72 cents away from the target. So what we did is we took the highest intraday price, less 72 cents. It gives us 97.56. And now we're trying to kind of make sure, or try, that if this stock falls down to 97.56 to trigger it to sell. We do not know exactly what the prices would be because those options can be sold at their market price. Okay? Save, confirm, send. Now it says illegal. What does that tell us? Well, it tells us in this case that there is like some existing stop on it. I'll cancel that order. Okay? I'm going to put that right back on. And now we're going to see in this case, if we pull that back up, okay? And I could just put that in super quick, slide it over, and now, all of a sudden, and by the way, this is going to be something that you're probably going to be doing frequently. This is option trading off the stock price, okay? And now what you see in this case is if we go at or below these, now you have to make sure when you type in these numbers that they match down here. If they don't match down there, you need to make sure you type it in and press enter. Do not assume, verify. Okay, save. Any questions with that? Confirm send. There you go. Now, here's the thing. When there is volatility spikes, okay, which strategies are at most risk? Does anybody know that, the answer to that question? If the market becomes more volatile, which strategies are you the most concerned about? For me, I mean, if you ask me that question, I'd say the strategies I'm most concerned about are stock positions. Why? Because they have the highest delta. Second strategy, what's the most concerning? Long synthetics have the highest delta, okay? Third strategy that's actually the most concerning, short puts. They're actually at risk to not only the price going down, but then volatility going up. So the loss could almost seem more severe because of the effects of volatility. So in the mind is, if someone said, I need to focus on my verticals, the verticals is after looking at the stock positions, looking at the long synthetics, and then looking at the cash secured puts. Now, does it mean that everything is bearish? Well, let's take a quick look. Now, we know if there's volatility in the marketplace, we could actually have some areas go up. We said on Friday, hey, could gold actually go up? Could silver go up and so on? Let's just take a quick peek. I'm not going to do a gold position per se, at least on the price. But when we actually look at, let's say, kind of the way gold has responded, if we look at, let's say, gold itself, wasn't gold just at 4,000? Now, I'm kind of sensitive to this right now. My son is probably going to propose to his girlfriend. And I said, it'd be great if you kind of made up your mind sooner than later if that trend continued, okay? Hope it's not too bad. Now, the other thing is not just, let's say, gold. You're actually seeing that high-ho silver. Now, the question is, are these moves actually helping like stocks like NEM, okay? Now, are they helping things like AEM? Now, what I'm going to do is, let's imagine someone says, well, James, I want to maybe, let's say, buy the shares, but I'm a little shell-shocked when I see markets move down. Wait, you weren't shell-shocked when the market went up. I mean, the market went from 57 to, let's say, it went up 54%. You weren't shell-shocked when it went up, but when it goes down 4%, all of it gives back just 10%. All of a sudden, we doubt everything sometimes. Now, I tell you this because I've been there, okay? It's kind of funny when you look back on it, you're like, that doesn't really make any logical sense. But sometimes we're not logical. Now, let's imagine the investor says, I want to be bullish. I want to buy the shares of the stock. That's what I normally do, the investor says. But I also maybe want to just have some protection in place just in case. Well, that could actually mean maybe they're buying the shares and buying a put, which is the right to sell the shares at the strike price. Second, they could buy the shares, sell the call above, try to get some income, use that income to then buy the put. Now, when you came back, zoomed in on this and said, well, is it still bullish? Well, the 10-period moving average, if I look at that, it looks like it's still red, but the 20-period, if I'm right on that, really looks like it's actually gone. And I just want to verify, I'm just looking to see exactly which moving average that is. Following this right here, it overlapped right there. Yeah, which this is odd. The 10-period moving average is still red. Now, the moving average is close to the price. As of Friday, should have been the shorter term. Just want to verify. Oddly enough, we don't see this very often. 20-period moving average is red, is green, okay? And we're just kind of waiting for that moving average now to go back green on the 10, okay? Normally, you see the shorter term get green first. Now, let's imagine the investor says, look, I'm gonna buy the shares, okay? And If we come in and let's say, well, look, we're going to buy the shares of stock, step number one, we're going to just click on right on the ask price. Okay, so go to the trade tab, not too bad. Type in the shares, click on the ask price. Now, one of the things that volatility teaches you is, number one, how allocated were you to the market? Meaning, or I should say, how invested were you in the market? What percent did you have invested? Let's say you said, James, I was 90% invested, 10% cash. Well, the higher percent you had invested, the volatility could affect you more. Second, it also kind of teaches something about allocation. What were you invested in? The third thing it actually teaches you is strategy. Did you pick strategies that were more sensitive to direction, up or down? Were they strategies that had maximum gains or losses? And were they strategy that were exposed to volatility or not? Volatility teaches you a lot more than when markets just go up. I mean, frankly, that's just simply true, okay? You actually now have to start thinking about strategy versus buying something. I just hope it goes up. That doesn't teach you a whole lot. Now, what I'm going to do is we're going to buy the shares of stock, 100 shares of stock, $8,900. Step two, we're going to come to single order. We're now going to go to First Triggers SEQ. We're going to do this step by step. Now, remember, when you sell a call, you're really saying, now remember, a lot of times when the volatility is down, I'm saying the VIX, people will say things like, well, you know, the VIX is low and the premiums aren't that high. Well, wait. So when the VIX goes high, the volatility is higher in not only the market, but in many individual names. When the volatility is higher, it might be more advantageous to sell. When the premiums are higher, the break-evens are lower. Okay, so it kind of resets things. So if every time things go trend one, that the investor takes 2 to 3 weeks off, that's not historically the greatest time to take off. You actually tend to want to say, look, I'm going to look for things to maybe potentially get in. Now, you might start off with things that are showing number one relative strength. Now, let's imagine I live in Salt Lake, and I said to myself, hey, we're in a recession, and I'm looking to maybe buy a house. Well, I might go to the neighborhood that's actually held up in value maybe more, okay? Second thing is, I also might say, hey, are there any things that maybe have been beaten down in price that might kind of have maybe the potential to bounce back? But a lot of us tend to focus on the relative strength first. What's something that's actually been strong? It's not that it hasn't stayed up completely. It might be negative, but it hasn't gone down as much as maybe Salt Lake in general. Just giving you an analogy, okay? It's not a bad analogy to the stock market. Now, what I'm going to do is I'm going to go to, let's say, we're going to sell the call that's out of the money. Now, remember what I said before. Volatility goes up. It affects most stocks. You go look at the implied volatility on NEM here. It's at 50. Remember, higher implied volatility, bigger the premium. So what does this mean? It means if the investor agrees to sell the shares at 95, they get a premium of 315 if it gets filled to that. That means that they get up to the 95 plus the 315. That means they'll make up to, let's say, 98.15. Now, the goal here is I'm not going to use that completely for an income strategy. We're going to use that to buy the downside protection just in case. Now, what you're now going to notice is we're going to take the 315 and we're going to use that to come over here to the put side and buy the put. So for some investors, the goal is they might use all of that. Okay, now I'm going to move to 320 and I'm going to come over here and click on the put that we want to buy. Notice that the call and the put have a delta of about 35-ish. So if you have 100 shares of stock, you sell the call at 35 delta, you buy the put at 35 delta. Your delta typically on a caller is really going to be about 30. Now, who cares? Well, the person who understands cares. So now if we do a strategy that has a 30 delta and someone says, and I say, but the market is volatile. Well, nobody says you had to pick a stock position. Okay. If, for example, the market is more volatile, more stocks are going to be volatile. So now by picking a strategy that has a lower delta, if we go up +1, +2, +3, and so on, you could do the math. And the same thing, if we go down, down 2, down 3, you could do the math. So if the market becomes more volatile, some investors might say, James, number one, I want a strategy where the delta is lower. La la. And then number two, I want something that if it tanks to the downside, people will say, I want to know that we have a contractual right to sell at 85 from now to expiration. And who has that right? The buyer does. Okay? Now, kind of an interesting strategy. Classically, this is really a caller, but we're going to call this a buy right caller. Okay? Buy right meaning we're buying the shares, writing the call, but we're actually using that call premium to buy the put. When we pulled up this diagram on the risk profile, it's going to look like a vertical that's on, well, I'll just say it's amped up, okay? A typical vertical might only have a delta of 10, but if we did it with a stock position, the delta is going to be higher. Why? Why is it higher? Well, no kidding, because we're buying the shares of stock. So it's like really kind of having 3 or 4 verticals for every one vertical that you really do, okay? Now, what we're going to now show, confirm send, here it is. Now, we are going to show a bearish position, but I want to show you this. So if you are in the position that you say, hey, James, I think the market's going to be a little bit more volatile. We got earnings season coming up. Financials are actually kicking off. I'm a stock investor, and I want to I'm thinking that we could maybe go sideways even. This now gives us up to 95 cap, which is about $6 higher than where we are now. There's a floor, meaning a right to sell at 85. Okay, so it can only get so good to the upside. It can only get so bad to the downside. Now, the comment from Ray is, why not do a synthetic with protection? I never said we couldn't. Okay, this now, why, for example, now, Ray is just kind of, he's saying, why, for example, instead of buying the shares, why not just do a long synthetic? If we wanted to go there, we totally could, okay? Let's kind of focus on that tomorrow. But I'm kind of starting with, what do probably most people do? Most people, if they're in the stock market, they're buying shares already. Now, wait, can you put on this position and this position after you have shares? Yes. When I say yes, you need to actually go look at the option table and see if the options are liquid to try to get a fill. So it's only yes if it does trade options and are they liquid and so on. You need to confirm that, okay? Send the order. All right, now, I want to kind of pull up something just real quick. So I think when we kind of go into the earnings, a buy right strategy, buy right caller strategy might not be a strategy bad per se that some investors might consider. Buy right caller, okay? If we buy the shares and put the caller on at the same time, okay? We're just saying we see an entry right now. We're seeing a setup. If the investor actually says, look, I have the shares, but I'm starting to see some weakness, they're legging into the caller, meaning they already have the shares. And now what they're doing is they're just selling the protection. Now, I want to kind of just give you a quick example what I mean by this. Let's say the investor says, James, I want to be long Uber, but I really don't like the trend that we're seeing, and I really don't like what I'm seeing here. How long does it take to actually put the caller on? Now, I already know we're looking for 20 to 50 days to expiration on monthly options. Why the monthly options? Tend to be more liquid, okay? Tend to be. We can verify. Which call are we going to look to sell? 30-40 delta. Which put are we going to look to buy? 30-40 delta. Why? Well, because when we actually look to do a caller, we're trying to target a delta on the position total of about 20-30 delta. If we had 100 shares of stock, we tend to want to have some upside potential. This some upside potential tends to be $1 or $2 out of the money. $1 or $2 out of the money typically, or 1 or 2 strikes out of the money, tends to have a delta of 30 or 40. And then to the downside, we tend to want to actually have a strike below us, 1 to 2 strikes below us, which tends to have a delta of 30 to 40. And you can see how this plays out over and over again. So now what I'm going to do is, how long does it take? We pull up Uber. Okay, pull up Uber. Number one, what we're going to now do, now, by the way, if someone said, James, could we just go look? I want to kind of just see, could we do a weekly, etc. I'll show that. If we came in and said, look, we're going to sell the hundreds, we're going to right click. Now, why there? That's the first one that has a delta of 30 to 40, kind of getting something there in the middle. Could we do this one? Yeah, not as much open interest. It's this one. If we actually right click on the 100, sell, now what we see in this case, we're going to go right to where it says call or synthetic. Now, if we did that, call or synthetic, we're now just saying, let me show that one more time. All we did is right click on it, sell, and then now go to call or synthetic. Okay. Now, if we did this, the top line, the 100, that's the strike that we're selling. On the put side, if I came over and said, what has a delta between 30 and 40 that has some liquidity? Well, 92, 91, not that much. It's probably going to really be about, let's say, probably the one that has the highest open interest is the 90. I stress again, why do we look at monthlies? Because the monthlies have more on the open interest, okay? Tighter bid-ask spreads. If we did the 90s, how do we do the 90s? There it is, okay? Now, it's not probably fathomable to think that every position we have has 100 shares. So that's why understanding stop losses, okay, manual exits, being able to visually identify them, et cetera, is important, okay? You're going to have different accounts with different balances. Hence, not everything is going to have 100 shares. But if you're saying, look, I'm trading an account or investing in an account where I have 100 shares, the investor might consider the strategy. Now, if I take a look at let me show you a couple stocks that actually look a little tough in terms of trend. We do not want to kind of, act like that everything is just bullish. It's not. Now, if I showed a stock like CE, that's been down for a while. I mean, it hasn't even really gone up with the market in general. We know that, for example, Starbucks has had a rough go at it. And who's to say that actually that 78 is even going to hold to begin with? Now, by the way, you take a look at, let's say, a stock like Target. Target has not participated to the upside and then got really pushed down on Friday as well. But could someone go bearish, maybe stocks that have really gone up a lot? You could, okay? And if you look at, let's say, what about Apple? Wonder if you actually think Apple could drop, okay? So if you do uptrending stocks, you really have to be able to identify the resistance levels, okay? Now let's take an example bearish. Last week, we did a trade on CSX. Does anybody remember that trade? And we said, example given, we said, look, we can identify a line of resistance, okay? And the trade on CSX was really a short call vertical credit, okay? And you were thinking that the price could stay below resistance, all right? And then what we said was, it's great that you get a credit, but I wonder if it really pulls back more. Could you actually sandwich together short call verticals and a long put to make a bearish trading strategy? Yeah, okay. A short call vertical and a long put is really a caller without the shares. It's also known as a synthetic. That's why when you come to this and you right click, go to sell, that's why it says caller synthetic, or also known as combo, okay? Now, the trade that we actually did, let's pull this up for just a second, then we're going to we'll talk about the exit, and also we'll talk about, in this case, a new example. Here's the trade down below. Now, how many of you feel pretty comfortable with a short call vertical? You could really think of like a short call vertical down here as just like it's a bearish trade. where you think the stock is going to stay below the strike price that you sold. It's not that bad, okay? Now, by the way, you could say, look, if I sell a call, think like a covered call. If you sell a covered call, what do you want the stock to do? You'd like the stock to stay below the strike price so you get all the premium. Exactly. Same goal here, but we don't have the shares. If we sell a call, okay, just in case that stock were to go to the upside, we actually cap the upside loss by buying the 40. Okay. Now what we're doing is we took the credit there and then we bought the put. So which side of this trade tends to have more management? Answer, it's the short call vertical, because that's the side of the trade that's capped. You're probably only selling the long put when the stock goes down to support, okay? And you're probably considering rolling the call when actually maybe you got 50%, 65, 80%, because it's a credit strategy, okay? Now, the question was asked on Friday, well, how do you actually maybe manage the stops, etc.? Well, you could actually set stops off the highs or the lower highs or resistance in general, okay? Just like you could use lows on bullish trades, higher lows on bullish trades, or supports on bullish trades to adjust stops. It's the exact opposite, though, for bearish positions. Let's put on a bearish trade. And if you're a Starbucks fan, I'm not targeting out any specific company. I'm just targeting a chart out. Let's say the investor said, James, I think Starbucks might actually have a tough go at it. And they think, for example, that Starbucks could continue to fall to the downside. And they look at the chart and they say, look, I think actually Starbucks could stay below 85. And they decide to sell the call at 85. Now remember, wonder if you're wrong. Now you got to ask yourself that question. Wonder if you're wrong. Now, I'm a man, so I got to ask myself that question all the time. Now, what I'm going to do is going to go sell and then vertical. Okay. You like how humble that was humble. Okay. Give me some credit. Okay. Had to read a lot of books to come to that point. Sell the 85, buying the 90. Okay. That $1.11 is going to go towards buying a put below. Now, one of the good things about high implied volatility is the credits are bigger on the call side. The bad part, the puts are more expensive too. Now, what you're now going to see is we have $1.11. We're going to come over here to, let's say, the put side, and we're going to try to buy a put that is really, let's say, 1 to 2 strikes below us. Why only 1 or 2 strikes? Well, because we want there to be a pretty decent chance that the stock could actually go down to that price level, okay, and maybe touch it, okay? Now, what we're going to do is we're going to come down to single order. First triggers SEQ, and then what we're now going to do is we're going to click on that 75. Now, when we do this, how do we do that? We brought up the vertical. We went to first triggers SEQ. Okay, there it is. And then we went to the put that we're going to buy. And we just clicked on that 211 right there. And there it is. These are 2 single option strategies, short call vertical and a long put. Now, what you're going to see is the debit there is really $1. When we bring this up, we could actually now kind of see the breakdown of the trade. Now, this actually has a dual purpose in teaching you this. If you're bullish and your stocks start going down, you're actually learning how to collar a stock position to try to defend your position and or your portfolio. Once you start to understand that, you're thinking, well, I don't have the shares. And I'm actually starting to see the stock actually pull back. And if you collar the position, known as a short synthetic here, you're actually speculating that the price might drop. And you're trying to benefit from the decline in the stock price. Now, wonder if all of a sudden Warren Buffett, last thing I want to say here, buys Starbucks out for 100. Is there a max loss built into this trade? The answer, yes. Okay. So the main purpose of today was, number one, we wanted to talk about exits. We did on the stock trade. We talked about Microsoft. Two, we actually talked about buy right callers, which is a stock position showing an entry, but we want to kind of be a little less bullish. Third, we also talked about, wonder if I own a stock position and I'm starting to see some weakness. We talked about how do you put on a collar in that circumstance. Fourth, we actually showed an example of using a short synthetic, which is collar-like, just without the shares. As you do this more and more, you'll see how these strategies blend. One is using the shares, the other one doesn't have the shares. One is bullish, the other one's not. Okay, I'm out of my time. I've got Cameron May actually coming up next. Thank you, Rachel, and thanks to all of you. I tried to answer some of the questions I got from Friday here in today's session. This is going to be a theme that we actually discuss throughout the week and get more practice on it. So I want to say thank you for all of you being here today. And remember to subscribe to the Trader Talks coaching channel right on YouTube. And also remember that Cameron May is coming up next. And thanks again, Rachel, for your help here today. With that said, have a great day. And I'll be back on tomorrow at 11 a.m. Eastern. And Ray, let's hit your question you had regarding that synthetic example that we could discuss tomorrow morning at 11. Have a great day. Take care. Bye-bye.